Welcome to the Stock Market Palantir. Today we are going to talk about AI.
And specifically C3AI.
Yes, specifically C3AI, ticker AI, which has, well, it's arguably become the ultimate battleground equity in late November 2025. This is a stock trading dramatically below where it was even a year ago, and far, far beneath its 2020 IPO price. What really defines C3AI right now is this extreme divergence we're seeing between two entirely different types of capital. You have highly speculative retail positioning on one side, and on the other, profoundly cynical, aggressive institutional distribution.
Right. And that divergence is really where the analysis has to begin. The core question for anyone looking at C3.ai is the current price movement dominated by the probability of a technical short squeeze and some kind of M&A catalyst, or is the stock rationally anchored by fundamental operational weaknesses and just aggressive institutional selling? These two forces are fighting a war, and it's happening directly in the order book.
I approach this from the perspective that the fundamental narrative, while of course critical for long-term holders, is, for now, it's secondary to the technical market structure. My position is that the market mechanics position C3.ai primarily as a high-risk, high-reward convexity play. I think its immediate future hinges almost entirely on a single external factor, the possibility of a white knight acquirer emerging. And that expectation was, fueled by the Reuters report from earlier this month suggesting a potential sale was being explored.
See, I come at this from a completely different angle. I believe the sustained weakness is structurally justified. The price is, in my view, rationally anchored by deep operational concerns: the product identity, the cash burn, the execution risk. The massive institutional shorting activity we see, particularly in the concealed dark pools, well, that confirms that the sophisticated money is aggressively distributing shares because of these very real underlying weaknesses, regardless of any technical setup.
Okay, well, let's start with those market mechanics because they are undeniably extreme. My thesis is that C3.ai is currently mispriced purely due to positioning, creating the structural potential for a violent upward movement if any positive catalyst occurs. The first piece of evidence supporting this is just the sheer magnitude of institutional skepticism, which we can see expressed via short interest. Total reported short interest stands at 40.54 million shares. But what makes this critical is the percentage of the floating shares committed to this trade, 31.61%.
Wow. Yeah, that is a very high number.
It is. In trading literature, when you cross the 30% threshold of float shorted, you enter structurally dangerous territory. This indicates a massively crowded, high-conviction institutional consensus betting against the stock. And, this level of consensus by itself is a contraindicator for many technical traders. It suggests that if the prevailing view is wrong, the reaction will be amplified.
That's a compelling argument for the technical risk, I'll grant you that. But I think it fundamentally misses the institutional objective. A crowded trade is only dangerous if the underlying premise for the shorts is flawed. If an institution has modeled the operational trajectory and determined the fair value is materially lower, then the short is simply an expression of high conviction.
The danger I'm focused on, though, is purely mechanical, regardless of conviction. Let's consider the illiquidity metric, days to cover, or DTC. This metric measures how many average daily trading days it would take for short sellers to fully exit their positions. For C3.ai right now, the DTC is extremely high, hovering between 7.01 and 7.09 days.
And what does that mean practically for the stock price?
Well, it confirms the gamma squeeze thesis. If a definitive, positive M&A catalyst were announced, those short sellers would have 7 days' worth of frantic buying volume compressed into maybe 1 or 2 days of trading. They'd be forced to compete aggressively to buy shares in a chaotic, upward accelerating loop, paying any price necessary to cover their positions. Retail capital is positioning for exactly this scenario, viewing the recent trading range in the $13 to $14 area as a hard floor because any deal would likely include a premium.
I understand the mechanics of the technical setup, I do, but I simply don't buy that the structural mechanics negate the fundamental justification for that short interest. The stock's sustained weakness is, to me, entirely justified by structural skepticism about its operational model, And the high short interest is merely smart money expressing that justifiable skepticism. My thesis begins with what I call the product identity crisis.
And we're referring here to the wrapper versus real AI debate that's been, prevalent since the IPO.
Exactly. The dominant critique, even among informed retail discussion boards, is that C3.ai is not functioning as a true pure-play software as a service company. Not like a firm such as, say, Palantir, which has successfully positioned itself as an operational AI platform. Instead, C3.ai often appears to operate as a productized consultancy.
Can you maybe elaborate on that distinction for our listeners?
Certainly, a pure-play SaaS company sells a product that scales with minimal human intervention. C3.ai's model, however, often requires heavy human capital intervention. Engineers, data scientists, specialized consultants to tailor and implement the product suite for large industrial clients. This operational reality means C3.ai often has the expense profile and the low-margin business of a consulting firm, yet it has historically demanded the high valuation multiple of a scalable SaaS platform.
And this gap is what the institutions are targeting.
Precisely. This model discrepancy feeds right into the vaporware accusation. We frequently see commentary citing the company's historical reliance on pilot programs that allegedly failed to convert into broad, profitable, high-value production contracts. If their software can't scale without continuous human customization, then the lower valuation multiple is completely justified.
Okay, that's a strong fundamental argument against the valuation. But let's look at how institutions are executing this trade, because it suggests the level of coordinated aggression.
And that aggression is expressed through stealth distribution, utilizing dark pools. Institutions are exhibiting an abnormally high reliance on off-exchange venues, these are private trading platforms, for shorting activity. On November 26th, for instance, the off-exchange short volume ratio was recorded at 48.64%. This data point is crucial because it implies institutions are creating a massive, invisible supply wall.
Walk us through what that means. Why does shorting off-exchange make it stealthy?
Well, when large institutional orders are executed on the primary exchanges, they're visible on the public order book, which can trigger buy-side momentum. By trading in dark pools, which are private, institutions can initiate massive short positions and sell shares into the market privately, thereby bypassing the visible exchange order books. They're injecting a huge amount of hidden selling pressure into the ecosystem, actively preventing any sustained rally driven by retail hope. They are, as the expression goes, feeding the ducks with shares, but very quietly.
And finally, let's quickly touch on the third pillar of skepticism before we dive into the core debate: management distrust.
Yes. Long-term observers of C3.ai cite what they call the chameleon critique. They interpret the company's history, from C3 Energy to C3 IoT, and finally to C3.ai, as classic trend chasing. This perceived lack of focus creates a deep trust deficit, leading to suspicion that major partnership announcements, like the recent update on Copilot and Azure AI Foundry with Microsoft, that they are simply press release engineering designed to prop up a struggling share price, rather than substantive business commitments that will quickly generate profit.
This brings us directly to the core contention then. Is C3.ai defined by its fundamental reality as a productized consultancy, or by the mechanical opportunity presented by its structural illiquidity? I want to challenge the valuation thesis based on that productized consultancy narrative.
And I'd maintain that the difficulty in converting pilot programs into broad production contracts inherently limits the stock to being a purely speculative vehicle. I mean, why should the market award C3.ai a premium SaaS multiple when its actual revenue generation and expense model more closely resemble a high-touch consulting firm? The current low price range is, I think, fundamentally justified by this operational reality and the lack of pure-play AI credibility.
I acknowledge the historical trust deficit and the accusations of trend chasing, but let me pivot back to the technical reality, which is about asset value perception. That short interest exceeding 30% is evidence of an extreme consensus. If that consensus is proven even slightly wrong, say a non-transformational event like a successful conversion of a major Baker Hughes pilot program, or a deeper governmental contract, that structural positioning creates massive, disproportionate upside convexity. We have to remember that the market views assets like the Baker Hughes partnership or the extensive government contracts as potentially worth significantly more to a strategic acquirer, like a Microsoft or an Oracle, than they are valued today as a standalone entity. That potential M&A floor justifies the speculative long position.
But speculation relies on a catalyst, and a smart money is actively betting against that catalyst. Let's move to point 2 and analyze the trading data itself, the question of whether this technical setup is truly an illiquidity trap or if the institutions have successfully constructed a supply wall.
Right. I focus on the extreme illiquidity confirmed by the days to cover at 7.09 days. This is the existential risk. Institutions might be confident in their fundamental analysis, but they are playing a deeply dangerous game being so heavily short. It only takes one event, one rumor, or one unexpected filing to trigger that mandatory buying. The requirement to cover that much volume in such a short window is, well, it's non-negotiable once the news is public.
I appreciate the quantification of risk, but let me reframe the dark pool activity using a key data point. On November 14th, the off-exchange short volume ratio spiked to 51.95%. This state is critical because it occurred immediately after the Reuters M&A rumor broke. So while retail traders were initiating calls and buying shares based on deal hope, institutional capital used that resulting liquidity spike to aggressively initiate massive short positions quietly in the dark pools.
So they were using the optimism to short.
Exactly. They were actively betting against the M&A thesis, or at least betting that the premium would be negligible. This activity demonstrates strategic conviction. They are constructing a silent, massive supply wall precisely to mitigate any rally and prevent the illiquidity trap from springing. They're not accidentally caught. They are calculatingly building the short position.
That is a powerful argument for institutional maneuverability, but I think it fundamentally misses the inevitable endpoint. The shorting only serves to increase the number of shares that must eventually be covered. If the rumor proves true, the institutional skill in initiating the shorts quietly becomes irrelevant. The structural setup means they still face exponential risk if they're proven wrong about the existence or timing of a catalyst.
And that reliance on hope, the hope for a catalyst, brings us perfectly to the ultimate structural blockage for any buyout, the dual-class share structure. This is often cited as the poison pill that keeps the stock undervalued.
The control structure risk.
Precisely. Founder Thomas Siebel retains approximately 52.4% of the voting power via his Class B shares. This dual-class structure acts as a severe impediment to a clean sale because no M&A deal, regardless of the premium offered, can happen without Siebel's explicit approval. This explains why the stock might perpetually trade at a persistent discount to its potential buyout value. The controlling interest makes any deal uncertain and complex.
I see why you emphasize that control risk. It certainly complicates the M&A narrative. However, a significant minority of speculative traders viewed the recent leadership change, specifically Siebel's September 2025 resignation and the appointment of Stephen Eki Han, as the new CEO, as a necessary catalyst for a buyout, not an impediment.
How so?
They viewed the new CEO as a kind of caretaker move designed to clean up or dress up the asset for a strategic acquirer, like an Oracle or a Microsoft, suggesting that the controlling shareholder is finally ready to monetize. Furthermore, we shouldn't confuse C3.ai with a dying microcap. The company's capital history, specifically the 6-for-1 reverse split executed prior to the IPO in 2020, shows they strategically engineered their price for a premium debut. Yes, the current price represents massive value destruction relative to the $42 IPO price, but this decline isn't indicative of the fundamental structural failure typical of companies undergoing dilutive reverse splits just to avoid delisting. It's a repricing, due to poor execution, not insolvency.
I'm just not convinced by that line of reasoning because the market already had a clear opportunity to rally on what should have been genuinely good, de-risking news. The November 20th Microsoft partnership announcement regarding Copilot and Azure AI Foundry was a concrete product update, yet the share price was instantly faded by institutional shorting, resulting in that 48% short ratio. This suggests to me that institutions prioritize the certainty of operational cash burn, the execution risk, and the low-margin consultancy model over incremental product updates or even M&A speculation. The market is waiting for profit conversion, not just partners.
Ultimately, C3AI is a highly volatile stock pinned between two opposing, deeply entrenched forces. Despite the fundamental skepticism and the valid critiques regarding the productized consultancy model, the high volatility and the sheer magnitude of the 31% short float means C3AI remains a high-convexity, binary beta gamble on an external M&A shock that would reward speculative traders disproportionately if they are proven right.
And I'd reiterate that the overwhelming institutional data clearly points to distribution and deep, justifiable skepticism regarding the business model. The price action is fundamentally a rational repricing of risk, moving the stock from the high-growth AI bucket into the distressed asset M&A target bucket. This distinction is entirely warranted by the operational reality and the difficulty the company is having in converting those pilot programs into broad, scalable production contracts. The immediate future is pinned between the certainty of poor upcoming earnings — analysts are expecting a loss of, negative 32 cents per share — and the possibility of that surprise buyout announcement keeping implied volatility extremely elevated.
That tension defines the C3.ai trade right now.
It certainly does.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.